Hey guys, let's talk about what's going on with the Fed and with interest rates. And I'm going to explain to you all the details in a really common sense approach to help you guys better understand what the Fed is doing, what Trump is doing to push down the interest rates, and why that's important for you guys, especially if you're in the market to either refinance your house or buy a new one. So let's get started. So what's going on right now is the Fed and the people inside the Fed are trying to decide if they should lower interest rates. Okay. Now the Fed rate is different than a mortgage rate. So the Fed rate is bank to bank lending rate. So for example, if I'm Bank of Steve and you're Bank of John and I want to borrow money from you overnight, the Fed rate is the rate that you would borrow it at. So if that Fed rate was 3%, then you, Bank of John, would be borrowing money from me at 3%. Then what you would do is you would take that money and you'd lend it back out. And then you make money on that money. So for example, if you wanted to give a bunch of car loans out there or a bunch of home loans out there or whatever it happens to be, then you're loaning that money out and you're making interest on the difference of what it cost you for the money versus what you're charging for the money. Okay. So that is not a direct correlation with what the mortgage rates are doing or what a car loan rates are doing. It's just the cost of money for the bank. Now, what should be happening, and I'm doing air quotes here, should be happening is as the Fed rate lowers, which means the cost to the banks lower, the banks should be passing on that savings to you as the consumer. Sometimes it's really quick and sometimes it's not. Sometimes it happens and sometimes it doesn't. Just be aware that that's in a perfect world, that's how it should happen. Now, let me explain the movement here of what Trump is trying to do with the economic process to stimulate you as the home buyer to buy more properties or to refinance your properties to stimulate the economy. Now, before I get into this, do me a favor, if you don't mind, like or subscribe to this, click that button. I really want to hear your comments on this as we continue to talk. I want to get your feedback on this, make sure that it all makes sense to you guys, because I think it's really interesting when you understand this from a common sense approach. And I appreciate you watching this today. So let's go ahead and continue. Now, Trump recently announced that they were going to buy $200 billion in mortgage-backed securities. It was Fannie and Freddie to buy $200 million in mortgage bonds. Let me explain what this does. Let's say that you have a pair of glasses, okay? And you want to sell these glasses on the market. Well, if there's 1 million glasses out there, the price of this pair goes way down. All right, there's plenty of supply. However, if there's only 100 pairs of these out there and there's a lot of demand, but you have low supply, I can sell these for more money because there's less competition, okay? So I want you guys to think about that supply and demand for a second. Now, what Trump is trying to do is force these rates to go down. So by the Fed creating this demand for these mortgage-backed securities, like I have a lot of demand to pull all of this stuff off the market, I'm going to buy it. What that does is it drives down rates because I don't have to increase my rates so much to sell my products, okay? Because there's a big buyer out there buying my product now, my product now, I can lower my cost. Okay? I hope that makes sense. So mortgage-backed securities are inversely proportional to interest rates. So let me explain. If we have a pool of loans, okay, so what happens on a mortgage loan is it gets closed, it gets sold to a servicer of some sort, and that servicer buys chunks of mortgage loans at one time. So if I'm a servicer and I want to buy $500 million of the B worth of mortgage loans, I'm going to offer a specific price to the person that owns those loans and they're going to sell them to me. Now that person selling to me has to make a little bit of money. So I'm going to offer what's called an SRP, which is a service release premium, which means, hey, I want what you've got. I'm going to pay you 1 or 2% over what the worth is. So that way I can grab all of those mortgages from you, and now I have them, and I'm making servicing money, okay? Now, the only way that we do this is like lots of money getting dumped into the system, like Freddie and Fannie buying $200 billion worth of these things. So it's large organizations, large groups buying these mortgage-backed securities. Well, listen, when you buy these things, okay, and you're trying to take them out of the market or you're trying to pull them in, it creates opportunities for rates to go down. All right. So it artificially moves rates. Now, the goal for this is to keep those rates low, where they will sit and they will stay. It may or may not work. It's been a slow process, but we are starting to see rates come down. So let me back into this again. If I have a bunch of mortgage-backed securities and I want to sell them, if the economy is super strong, people will make more money on buying stock, as an example, than they will putting their money in mortgage-backed securities. So therefore, I have to make my mortgage-backed securities more attractive, right? I have to pay more to the investors to make them buy what I have, which means I'm increasing interest rates, okay? But if somebody comes in and buys a bunch, that creates a shift from these people who were in stock going, wait a minute, they're buying a bunch, I want to buy a bunch too, and they'll shift back over here. And because I'm selling a lot more, I can lower that cost. Stocks then, if they want to attract people, stocks will generally go up to re-attract them. And so you have this constant balancing. What we need to happen is this mortgage side to continue to drip down and down and down, where there's more and more people willing to trade the mortgages. And that way it drives the overall cost down for everybody. And then you have rates that are much more attractive. And then what happens? When rates are attractive, people buy homes. And then people that are stuck in these super low interest rate mortgages finally feel that they're going to be in a good enough position where they can go ahead and sell that house and get rid of that 3% rate, because the new market rate's only like 5%. It's not a huge jump. And they've been wanting to get into this house for the last 5 years. So you're creating a market shift, okay, on how this is all working. So the catalyst to that shift is that huge buy by Trump, Fannie and Freddie, trying to inject into the market a forced push down of the interest rates. Now, in my opinion, I've been in the industry for over 26 years. This is a smart decision. Trump is a big fan of low interest rates, and you should be a very big fan of that too. Housing in general is about 18% of GDP for the United States of America. So the stronger the housing market is, the better it is for everybody. You've got to think all the wood manufacturers, all the builders, all the trades, everything that's existing out there today. It's all because of homesteads, right? Lawnmower sales. I mean, you get all kinds of stuff that goes into people buying and selling homes. So you want the home part of the GDP to be very strong. Plus, people that own homes pay more taxes. They do these other things, insurance companies. I mean, there's a whole litany of things that you can think about when the mortgage market is strong. So our goal right now, or what our goal should be in this country, is to push these rates lower. All right? Now, what do I think the long-term play is going to be here? This is where it gets a little sticky. So remember who's in the Fed right now. We've got Powell, who leads the Fed. Powell was here before Trump took office, or this most recent time in office. He's a little bit of a stalwart, and so he doesn't always cooperate with what the administration wants him to cooperate with. And I get it. I mean, the guy's been around a long time. He's trying to do what's best by everybody else. But we've got to think about it from a perspective of a financially sound process for mortgages to get stronger in our economy. How do we do that? We slowly lower that Fed rate. Now, there's some other things that could happen at this point in time, which they could force these banks, as an example, to lower credit card debt. Guess what? They just did. So they made a 1-year memorandum on interest on credit cards to 10%. Now, why is this important? This all ties together, guys. If you're a consumer and your credit card payment just got cut in half because instead of paying 20%, you're paying 10%, you have more money. You've got a couple of choices that you can do with that money. You can save it. Hey man, kudos to you. I hope you do. Or you can spend it. That's cool too, right? You've got to figure out what's best for your family. But either way, I'm injecting money into the economy. Here's how. If I save it, that bank is taking my money and it's lending it out. Okay, now it has more money to lend. If I'm spending it, well, then I'm injecting money into the economy. So by lowering costs, not just on houses, but on short-term debt or other types of debt, it pushes cash into the market, which allows you as the consumer to spend that money however you see fit. So instead of getting these big bonus checks or whatever from the government, and I'm using air quotes here too because they're not free, taxpayers pay for them. If we can lower the cost of money for mortgages, for credit cards, for cars, for boats, etc., where it gets very inexpensive for a loan, you're going to see a rapid increase in spending, okay? Because people have always wanted to be able to buy these things, and now they can afford to do it. When you create affordability, you create buying power, okay? So I hope this is making sense. So the goal for everybody to be solid in our economy is low interest rates across the board, especially in housing, because of 18% of our gross domestic product. We definitely want lower interest rates in cars. We want limits on the interest rates on credit cards. And we want to have more money every single month to spend. Now, when people start shifting in and out of houses and putting more houses on the market and buying more houses, you get rid of the glut of houses that are on the market now, okay? And we get a stronger and a more consistent economy in every major city in the United States of America. Now, there will be pockets of everything. In some parts of America, there's going to be turndowns because businesses may have got a business, or they may be doing layoffs, or whatever it happens to be, depending on what's going on from a world perspective. But from a United States of America perspective, that means a solid, strong economy. So you're going to see future injections, I believe, where Fannie and Freddie are going to step in. You may see some curbs on interest rates. The administration is a big fan of low interest rates, and the reason that they are is because they've spent a bunch of time, Trump and everybody that works for Trump, in the market, in the economy, and so they understand the benefit of low cost to consumers. Okay? Listen, I hope this educated you guys. I hope this gives you some good information that you can use and that you'll understand what's going on in the market as you see news come out. And that way you can make a great decision as to when the best time to buy is. Now, I can tell you, homes aren't getting cheaper. Land's not getting cheaper. There's only so much of it. So it's more about when it becomes affordable for you to pull the trigger. And that's something I can answer for you in the same day or within one business day. Let's visit. Let's have a conversation. Figure it out. And I appreciate you guys. Thanks for watching. And share this with your friends and family. All right, we'll talk soon. Have a good one. Bye-bye.